Alibaba's the biggest stock owned by legendary investor Michael Burry, and they just announced plans to merge all of their e-commerce units. Does it mean that Alibaba, ticker symbol BABA, is a good stock to buy now? In today's video, we're performing a fundamental analysis of Alibaba using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Alibaba's worth in today's stock market at the end of the video. Plus, I'll share a special bonus that could be the deciding safety factor when adding Alibaba stock to your portfolio. Right now, at the time of recording, Alibaba trades for $83.12 per share. In today's day of trading alone, it's down 2.87%. In 2024, Alibaba stock is up 17%. This trails the S&P 500, which is up 24% at the same time. But the company was beating the market until September when they started to pull back from their 52-week highs. In the last 5 years, since the late great Charlie Munger invested in the company, Alibaba stock is down 55% overall. This is hugely underperforming the market. Since their listing over a decade ago, Alibaba beat the market until 2021, but they've underperformed for the last 3 years in a row. Added to the returns in their last couple of years, right now Alibaba pays a 1.21% dividend yield as well. Today, Alibaba stock trades $17 above its 52-week low, and they're down $30 from their 52-week high. They remain a huge big tech company, and they have a $195 billion market cap as one of the largest companies in China. Getting started with metric number 1, we want their average returns on capital to be greater than 14%. Think of returns on capital like your form when you're in the gym lifting weights. You want to have great form, and a company wants great returns on capital. A normal business earns 7% returns, so we can build in margin of safety based on these returns being double that. In most of these years, they've earned just about average returns, somewhere between 7 and 9%. These declined going into 2022 as the company had trouble with Chinese regulators. But since then, they've been on a steady march upward, and they actually have 10% returns in their last 12 months. Still, when they're averaged out, Alibaba only earns 8.5% returns on capital over this time, and that's just a little better than average, but below what we wanted. This is an X on our first metric. Now, what does Alibaba really do? Alibaba is the world's largest online and mobile commerce company as measured by gross merchandise volume. It operates China's online marketplaces, including Taobao and Tmall, its consumer-to-consumer and business-to-consumer offerings. The Chinese Commerce Retail Division is the most valuable cash-flowing business at Alibaba. Additional sales include Chinese commerce wholesale, international commerce, which is their retail and their wholesale, local consumer services, cloud computing, digital media, and entertainment platforms. They also have Cainiao logistics services and other innovation initiatives. The company made headlines when the late great value investor Charlie Munger started a position both for himself and for the Daily Journal Corporation. In his final CNBC interview, he called it his worst trade ever, but he said the company was still pretty good. This was after Alibaba founder Jack Ma publicly insulted Chinese banking regulators, and the company suffered from regulatory crackdown. Part of Alibaba still being a pretty good company is why 7 super investors own it in their portfolios today. This is led by Michael Burry and David Tepper, who it's both the biggest position for. Burry has a 25% holding that he added 29% to in the last quarter, and Tepper has 16% of his assets in the company. Next, we want growth in their sales, earnings, and cash flows. In the last 5 years, Alibaba grew their sales by 90%. Yet at the same time, due to regulatory fines, crackdowns, and increased competition, their earnings are down 42% and their cash flows have declined by 30%. Overall, this means their margins are down and the company's less profitable today than it was 5 years ago. Still, super investors are betting that these will stabilize and possibly even improve going forward. However, this is an X on metric number 2. Next, we want to look at Alibaba like an individual shareholder. In metric number 3, we want their earnings per share to have grown over this time. Unfortunately, that's not the case. Their earnings fell off a cliff from 2021 until 2022, and while they have grown since then, they're still down from where they were at 5 years ago. This is also an X on metric number 3. Now, something that may be on the bright side for most shareholders is that as the company's gotten cheaper, Alibaba's repurchased more and more of their shares. In the last 5 years, they've reduced their shares outstanding by 7%. And they recently borrowed more debt to possibly fuel even more share buybacks. Metric number 4 is similar to the last one, but even more important. We want free cash flow per share growth. Alibaba's cash flows have done better than their earnings in the last 5 years. Still though, while these are up from 2020 until 2024, Today, these are actually down and they're sitting at just $6 per share, which is their second lowest over this last 5-year period. Because of it, it's another X on metric number 4. So far, not so good. But why do super investors still really love the company? Does Alibaba have what it takes to turn it around in the back half of our analysis? Why don't we find out? Before we keep going, it's time for our first bonus metric. Alibaba, similar to the American big tech companies like Meta and Google, started paying a dividend in 2023. Their dividend has easily been covered by their cash flows, which is exactly what we want to see. Right now, Alibaba pays a 1.21% dividend yield, and with their share buybacks, they have over a 5.6% shareholder yield today. That's not shabby. These supported dividends are great to see for shareholders. It's our first check of the day on our bonus. Alibaba has a very solid balance sheet. They've had a net cash position in each of the last 5 years, and despite some struggles, they generate a ton of cash flow. We want their debts to be covered by their cash flow, and this is covered by the cash they have on hand instead. Today, Alibaba has a $22 billion cash cushion, and they brought in $109 billion of free cash flow in the last 5 years. This is a big check on metric number 5, and it builds on that bonus momentum. Now let's look at how the company does in the short term as well. Warren Buffett's teacher and the father of value investing, Ben Graham, wanted to see a current ratio bigger than 1.5 times. This is a key safety metric for short-term liquidity of how a company can pay its bills in a hurry. Alibaba's been above this mark in each of the last 5 years. However, today, they're slightly below this. They only have a 1.37 times current ratio, which is just below that benchmark, but it is an X on metric number 5. It's not something to be overly concerned about, but keep an eye on this. Now, what is Alibaba worth? The big metric of them all, metric number 5, is where we want their average cash flows divided by their enterprise value to give us a yield greater than 5%. This would build in some margin of safety compared to the 10-year treasury and can help us better value the company. Right now, Alibaba has a $187 billion enterprise value. We'll look at 3 different time periods, including the last 5 years, 3 years, and their last 12 months to better inform this analysis. In the last 5 years, they bring in $21.8 billion in an average year. When that's divided by their enterprise value of $187 billion, it gives us an 11.7% yield. That is huge, more than double the yield of the 10-year. That's huge, more than 2.5 times the yield of the 10-year treasury. In the last 3 years, their cash flows are down somewhat and they bring in $19.7 billion. This also gives us a big 10.5% yield. Then, in their last 12 months, where they have their lowest cash flows over this time, they still bring in $14.8 billion. Even then, they have a 7.9% yield, which is more than 1.5 times better than the 10-year treasury. All 3 of these blow the treasury yield out of the water, and it's a huge check on metric number 6. The cheap valuation compared to their cash flows is likely a big source of attractiveness for investors. Now, we still have 2 more ways to value Alibaba before we figure out what they're worth and what's their fair value per share. Next, we'll use a discounted cash flow model to give them credit for their growth. We'll start with an average of their last 3 years of free cash flow and use historical assumptions to grow these into the future. Let's assume Alibaba can get back to their growth in their last 5 years. So they grow at 5% annually for the next decade. Then in the following decade, we'll assume this growth slows and they only grow at 4% annually. Keep in mind, these are assumptions that you need to do your homework on. Then added to all of this, we'll add in their tangible book value to estimate their net worth per share. After that, we'll use a discount rate to look for a 15% rate of return, which is the same return Warren Buffett and his partner Charlie Munger look for. Based on those inputs, today it looks like a fair value for Alibaba is $114 based on this DCF. That's pretty close to their 52-week highs. Our third valuation uses their GF value, which today comes in at $99 per share. That's up 16% from their current stock price. Now, Warren Buffett and Charlie Munger like the numbers, but it's a company's qualities that are their true love. Why don't we learn what these are for Alibaba before we put everything together and give them their fair value? We'll do this with a long and a short thesis, starting with the long thesis first. Number 1, Alibaba should be able to maintain or increase its gross merchandise volume share in China's e-commerce market. This would demonstrate its ability to execute its strategic turnaround. Number 2, Alibaba successfully has increased key metrics such as customer retention, purchase frequency, and average order volume. This has driven gross merchandise volume growth, and it's outperformed the growth of China's online retail sales of physical goods. And number 3, Alibaba's delivered better than expected margins despite increased competition and reinvestment, even though these are down from where they were at 5 years ago. But it's not all sunshine and roses. Let's look at a short thesis as well. Number 1, Alibaba's gross merchandise volume share in China decreased faster than expectations as competitors such as Douyin successfully entered the search-based e-commerce business. Number 2, expansion into the non-physical goods marketplace businesses and other regions has led to lower than expected margins, and the timing of profitability on that is delayed. And number 3, Alibaba has failed in its globalization, public cloud, and AI efforts so far, and it's delivered slower than expected earnings growth. Now let's put everything together for Alibaba. In our fundamental analysis, we learned the company checks 2 of our 6 metrics. While they earn just above average returns on capital and they've grown their sales, their earnings and their free cash flows are down in the last 5 years. And they generate a ton of free cash flow, including sitting on a $22 billion cash cushion. They've also returned a lot of cash through their share buybacks, and they've started a dividend which they paid in the last 2 years. The big attraction for value investors like Michael Burry and David Tepper seems to be how cheap Alibaba looks. They trade for some very low multiples compared to their cash flows and their current valuations. Remember, this isn't financial advice and it's not a buy or sell recommendation of any security. Alibaba's fair value per share comes in at $124.40. That's up more than $40 from their current stock price, and Alibaba looks undervalued. This is a company worth digging into. If you enjoyed the video, support the channel. Click the first link in the description to check out Global Value's affiliate, Interactive Brokers.